tells a story that then winds up being important for various lines on your return. You have two lines that are very critical that you need to be aware of. One is your adjusted gross income. It tells the rules. And this is really technical. Anything that happens above your AGI is called above line. Anything that happens below that is called below line. I know, very technical. Just as a general rule, things that happen above line are more important than things that happen below line. But you really need to understand the difference in planning from what's called an effective return, which Mark's going to put on your tax stuff for you and tell you your effective return, which is your average rate that you pay for every dollar that you earn. From a planning perspective, you need to understand your marginal rate. The marginal rate is the rate you pay on the last dollar that you earn. So when you look at your tax return, you really want to understand the bottom of page 1 right now. The IRS changes it all the time, but on the 2022 return, it's your taxable income. And that's going to tell you what actually makes it to the marginal rate. So you want to think about your tax return as a series of stair steps. So it starts at 10, currently it goes to 12, and then 22, and then higher from there based on your income going higher. The key thing, Mark, that people seem to miss is that we all get taxed at that 10% bracket. If you pay on the federal tax return, your first dollar after your deductions will be taxed at that 10% level, whether you're Warren Buffett, Bill Gates, or Mark, or Joe. And then you take those steps up. And so what we help people understand entering into retirement or entrepreneurs is to search for variability of income. And that's where most of those opportunities can come from. But you have to understand the difference between tax planning and tax preparation. You need a great CPA, a good firm that prepares your taxes, that virtually tells the IRS your story. The tax planning is what your CFP or your CPA, if they're in that line of work, helps you do before the end of the year. How do we prepare the story so that when Mark does your return, we tell the IRS the most efficient story, the truth, but the most efficient story as possible so that you can report and pay your taxes accordingly.
Yeah. So, and what we have here is in our profession, the majority of CPAs are focused on compliance related tasks and reporting what happened. And that can be fine for if that's all if there are no tax planning opportunities, perhaps in certain circumstances, right? So let's say you're locked into a W-2, or maybe you have a certified financial planner managing your finances and you need someone to plug in your W-2. There may be instances where, and you can't afford to invest or do financial planning. There might be some circumstances where going to H&R Block to plug in your W-2s in April might be what you need. But as in order to really plan for your future, you're going to need someone to advise you on your taxes. And when we specialize in tax planning, and we only serve clients if we can reduce their taxes, but we're very different from a lot of CPA practices. A lot of CPA practices are more focused on telling you what you owe in taxes, answering your questions, and getting the returns out on time. It's an entirely different business model. In our profession and professional organizations that we are part of, most of them that certify us, that credential us, don't teach us how to tax plan. So you have to be extraordinary and go above and beyond credentials if you are a CPA, or you need someone like a certified financial planner or CFA, someone else in your corner if you're going to think about taxes and your long-term tax savings.
Yeah, I think it's interesting. I tell people that I got my MBA, which I don't have, but I tell people I got it being a partner of a CPA firm for 12 years. And what happened is, as a CFP, I learned, Mark, what I thought CPAs knew that they clearly didn't. And I learned as a CFP what I thought to be true that clearly wasn't. And I think that's where that collaboration really becomes critical. You have to collaborate in my mind, with professionals that have their expertise in certain areas, but you also have to collaborate with strategy. And there is a definite tax planning strategy and a definite tax reporting strategy. And those strategies need to meld, they need to work in concert. So our cup of tea, our specialty, if you will, is that the industry is full of very unique characters with special skills that do certain things. And when Mark retires or Joe retires, years from now, we don't want you to have to start your financial journey over. And so at the Financial Enhancement Group, we're very dedicated to a process. So whether it's Joe or Grant or Aaron or one of my other advisors, you're getting the same story and the same process. We're going to call you the 1st of November every year to see what your income has been this year. And again, we're looking for income variability. And that's what Mark does in his practice. That's really unique, for those of you that are there. Most CPAs, just because they have those credentials, don't necessarily engage in tax planning. The challenge that I have as a certified financial planner is there's a lot of people in my industry, the majority of them, that ignore the tax return. And that's because they focus on that, what I call a one-hit wonder, that they let Mark tell the story, you get to deal with the consequence, and I want to help you with your financial journey to make sure that you're paying the least amount of tax over your financial journey, not necessarily in one individual year. That means you have to create strategies and be very diligent in your planning that's done each year. Mark can help you with that. You're not going to get that at QuickBooks or Intuit or H&R Block. That's not what they do. But this is more than just plugging in numbers, in my opinion, and what the 1,100 plus families we take care of would tell you is essential and made their financial journeys better.
Yes. And so, it's amazing. There's a lot of opportunities if you collaborate and you can put everyone together. If you have a bit, because the CPA, oftentimes, especially if you're offering additional services like CFO and bookkeeping, and if you're meeting with your CPA regularly, the CPA is going to help understand and connect you with other subject matter experts when it comes to asset protection and asset protection attorneys, or if you have a portfolio. And this is something that we're encouraging people to do. In fact, I'm sending a newsletter out to our clients in the next, probably this or next week, that if you have capital gains in your portfolio, we want to know in advance so we can look at the implications of that and other actions we can do with your real estate and all the other things in response to that. We can take advantage of losses, and we can also mitigate the gains. So when you can have people aligned together when we're looking at our planning situation and opportunities, that's where you're going to really see a lot of benefit in building wealth.
And I would just encourage you to understand what collaboration really means. Collaboration does not necessarily mean that we agree on everything, but it means we discuss everything and create that cohesive strategy, right? So I will commonly watch people at the local Rotary group or one of the other organizations I'm involved in say that, well, my advisor works with this CPA or that CPA. Well, what that means is they have lunch with them every Tuesday at Rotary, right? There is a difference between me sitting down with Mark, looking at your tax return prior to the end of the year. Remember, December 31st, it ends, right? Sitting down in a very proactive fashion where we collaborate in a way to tell that best story. That's where that tax planning can really occur. And when Mark's talking about those capital gains or capital losses, again, you really need to understand how that above line and below line issue works to affect your taxable income. There are things in terms of income variability that you need to be very well aware of. And one of those things that I will tell you about are inherited IRAs. Many of you are going to be receiving them. Many of your many entrepreneurs do not have large 401ks or large IRAs, but your parents likely do. And when they pass, you're going to receive them. And what I have found is most people don't understand how inherited IRAs work. First of all, the 10% penalty taking money out before 59 and a half does not apply. You can take any amount of money that you want out over a 10-year period of time, and then the account has to be emptied unless your parents were over 73 at the time of their passing. And then you have to actually take it out over their life expectancy. You have to take out some each year. But let's say you're doing tax planning with Mark and you've sold a property and suddenly you've got a big capital gain this year, right? You wouldn't want to take any money out of that inherited IRA that you didn't have to take. But now perhaps you have another year where for some reason, because of depreciation or some reason or another, something that's changed in the market, you have a loss. Well, Mark needs to know that before the end of the year, and you would accelerate the amount of money that you got out of the IRA because you would be at a lower marginal bracket that year. And Mark, if there's anything that I have seen that has jeopardized people's financial future over the years, it's not maximizing those lower marginal rates when they have income variability. And this is an important thing for you to be able to explain to your parents. It is nothing uncommon. I live in central Indiana. We take care of people in 31 states. I'm licensed in all 50. But in central Indiana, it is nothing uncommon for somebody who's got their house paid for to live on $25,000 to $40,000 a year of income, right? But they may have $1 million 401k or IRA that you're going to inherit, right? You need to help your parents understand how these tax returns work, because it's going to be in your best interest for them to actually recognize, get that money out from the IRA, what I call the stowaway inside of your financial journey. Get your parents to recognize that at 10 and 12% tax brackets, because you're not going to be at that bracket every year if you're doing things right. They're likely at a lower bracket. Get them to take out money, recognize it at that rate, even if you have to gift them the money to pay the taxes. It is in your best interest long term.
Yeah, that's really interesting. And, I've never had the opportunity to talk to our clients about this. And there, we do have a large population of obviously of baby boomers that there's a lot of planning to do here. And, the great thing about the IRAs is you can time the recognition of them. And you can roll them into Roth IRAs, and then they maintain that Roth IRA status when they inherit it, right? So, and then a lot of senior citizens, they don't need a lot of money because, your biggest overhead, which is your housing, a lot of them have already paid off the mortgage on their house. And
so let's hit that real quick, because a lot of people don't know that rule. So this is one of the reasons where I take care of a lot of engineers. They're very, very bright people, over 250 of them in my practice. And what happens is you don't necessarily need a CFA or a CFP or a CPA. And I know those are a lot of credentials and acronyms. You don't necessarily need them every day of your life. But the 2007 tax manual came out. It's about 2,000 pages. It's like this. And yes, that's 15 years ago. And in that 2007 manual that Mark would have gotten if he was already in practice, and I got, and my collaborating CPA partners got, none of us read it all. We're all assigned a portion of it. We know our parts, but if we're not collaborating, Mark may know one part and I may know another. You've got to have that cohesion where you're working together. But in there, it specifically said the same rule that was stated in 1997. And that was that you could not do a Roth conversion in excess of $100,000 of your adjusted gross income. And that included the amount of money that you did for the conversion. Now, what happened in the middle of the year in an email that I got, Mark got, you had access to, but probably didn't read, the IRS raised their hand and said, starting in 2010, so that's 3 years further, starting in 2010, you're going to be able to do Roth conversions regardless of age and regardless of AGI, right? So the oldest person that I've done a Roth conversion for has been 92, right? There is, and it makes all the sense in the world. All three of her beneficiaries were at a much higher tax bracket. She had money in a 403B. She'd been a professor at Purdue University. We took money out of her 403B, put it in an IRA, did a conversion to the Roth IRA up to the maximum at that time of the 15% bracket. It worked out beautifully for her and for her heirs, and it will work for you as well.
So here's something that we didn't realize people didn't know. We assumed they knew this, and it is that the difference between the timing for putting money into doing a rollover and contributing to a tax deferred account. So you can put your money into the IRAs and 401ks after the year is ended and apply it to the prior year, right? Before you file, you can put money into that SEP IRA. Even if the year has ended, I can put money in after December 31st. But if you want to do a Roth IRA rollover, not as much flexibility. So, and we did Q4 tax planning with all our clients this year. And for some of our clients, it's been amazing with 100% bonus depreciation, 10% owner finance, 10% second home mortgages on short-term rentals. A lot of clients, we were able to bring them down to $0 AGIs and $0 taxes.
Yeah, and so and when you have zero taxable dollars, that's fine. This is where you have to
put it in the Roth.
You have to be wise, right? So some of you or your spouse may have an IRA or a 401k, and perhaps you're not 59 and a half. And somebody tells you, well, if you take money out of the IRA, there's a 10% federal penalty. That's true. But if your tax rate is zero, because Mark's got your income to zero, that 10% penalty is effectively a 10% tax bracket. Sign me up for that. If I could pay the IRS today and be done at the 10% bracket or the 12% bracket, I would get the money and write them a check for all of the taxes and convert everything I had to a Roth at that rate any day of the week. But that is something that has to happen by the end of the year. So Mark used a term called rollover. There's three things that you need to be aware of when you talk about Roths or IRAs or even SEPs. One is a contribution. That's what you're eligible to put in this year. That actually goes beyond the first of the year. In a SEP account, the account had to have been open before the end of the year, actually even a little bit before that. But the contribution can be after January. With an IRA or a Roth IRA, the contribution can be all the way up to the date of the filing requirement of April 15th. So you could still put money in today for a Roth or an IRA for last year. That's the contribution. But the conversion has to have occurred before December 31st strikes midnight of the year before. So that has to be done. Now, how do you do a conversion? Well, Mark mentioned the word rollover. Rollovers are not something that I would ever encourage. A rollover is where you take the money out, you have what we call constructive receipt, and you've got 60 days to replace that into an account. Just be very, very careful. The IRS rules, and this is Google beware. If you go online, you're going to read publication 590. It will tell you can do that once every calendar year. The IRS says not a chance. It's once every 365 days. And don't miss the 60-day deadline. If you do, bad things will happen, i.e. full taxation and a 10% penalty. A transfer you can do anytime you want. That's where you take money from one custodian to another. We move money from TD Ameritrade to Charlie Schwab. We move it from Fidelity to another financial institution. A transfer happens without you getting a check in your name or with you touching the money. But you need to remember the two C's. That's how I teach it. And I apologize if I'm educating, but I'm a former professor from Purdue University. I teach this stuff. It's what I do, right? Yeah. There's conversion and contribution. The two are different, two different dates, two different amounts.
So I'm so glad you clarified this, because in our vocabulary, and most people will not distinguish between rollover and conversion. And as I've made this error right now, because we would have said rollover but meant conversion, and so this is the thing when we talk about tax planning and having a game plan here, and when we meet with our clients in Q4, you're going to hear all the foundational things in the Bigger Pockets blogs that cost segregation, bonus depreciation, you get all your tax savings, and that's great. But that's where most advisors stop. They say, great, we brought you to a $0 tax bracket. You get this great refund, time to celebrate, end of story. But you're missing out on so much additional opportunities. You don't want to let a low tax bracket go to waste. You don't want to miss out on all these other opportunities. If you have capital gains at the $0 long-term cap gains rate, why not liquidate some stock? You can, even if you want to hold on to the stock, just buy it back up at a higher basis.
So
and then
what Mark just did was said something. And so this is what's called the double curse of knowledge. This is why you need to hire Mark, right? The double curse of knowledge is Joe doesn't know what Joe doesn't know. But I also don't know what you don't know. Now, what Mark just told you was that if you are in the 10 or 12% bracket, your capital gains rate is 0. He has to put it on the return, but it nets out to 0 when they add all of that money on. So capital gains are deemed to be what's called preferential income. They already have a lower tax rate than your normal marginal rate. But if you have 0% income, you can have capital gains up to about $80,000 and pay 0 in tax. 0. I like that number. 0. So you've got to go look at your portfolio and see what stocks are in there that have long-term capital gains. Doesn't work for short-term. Has long-term capital gains. You've owned a stock for more than 12 months in a day, right? People get confused, Mark, on the 30-day rule. If you have something that's at a loss and you sell it, you technically have to wait 30 days to repurchase it, or you don't get to recognize the loss. Gains, that's not true.
No, yeah.
What we do for people that happen to be at that lower bracket is step up their basis. So my team is trained to look when they talk to you in November. If your tax rate is at the 10% bracket, we will go in and sell stocks and buy stocks, the same stock simultaneously, if it's a long-term capital gain, and just reestablish basis all on the back of what the IRS will not charge you a dime for. And if you're working with a registered investment advisor or a fiduciary like we are, the cost of trading is 0, right? You just need somebody who's willing to do the work.
Yeah, and so, because we've had 100% bonus depreciation under certain circumstances, certain clients who went big into real estate and put their savings into it, there have been instances where year after year after year, they can take advantage of this $0 long-term cap bracket. And, under perfect circumstances here with $0 taxes, imagine you do this 4 years in a row, 5 years in a row. I mean, hundreds of thousands of dollars of long-term capital gains tax that you're avoiding here. So, I mean, if you do it 5 years in a row, 80 times 5, $400,000 of long-term capital gains tax in the future, that long-term capital gains income that you could avoid. Because what's going to happen is we're going to lose this 100% bonus depreciation. Your properties get more profitable. It's going to get harder and harder to operate at a loss or towards that $0 long-term capital gains bracket. And it may not be as easy when we don't have a president who's a real estate investor to save money on our taxes. So, a lot of cool things here. And, I get asked this question so often, and you touched on it a little bit. We get asked this question by almost all of our clients who have retirement accounts. They say, well, I want to invest in real estate. I'm thinking about liquidating some of my retirement account to put into real estate. What are your thoughts? And I typically say you want to evaluate the tax savings you get from your real estate and how that's going to offset the distribution, the taxes on the distribution from your retirement accounts. But then there is a trade-off here. I want to get your thoughts. If someone's ever come to you and say, hey, I'm starting a new business, or I want to invest in real estate, I got these IRAs. What are your thoughts on liquidating them and the early withdrawal penalties?
So as I used to tell them at Purdue, I'll talk out of 3 sides of my mouth, right? I'm the Rodney Dangerfield of the industry. I did it before I got educated, right? So I call BS when I hear BS. So when I taught at Purdue, I taught as somebody who's a practicing planner, somebody who's a CFP, and somebody who has to comply with the rules that are out there that are of academia. And the three don't always coincide. Let's just put it that way. So first of all, I would discourage you, just because you legally can, I would discourage you from using IRA money as a real estate investment. I would always discourage you from using IRA money to start your own business. All right. Now, can you legally do it? The answer is yes. But here's what you need to be aware of. In Indiana, we call it poking the bear, right? You do not want to intentionally tick me off. And there are things that I don't like. And the IRS clearly says they don't like that, right? It creates all sorts of opportunities for taxpayer error, or, you know, non-compliance would be the word that they would use in the big leagues. And so you can do it. Keep in mind that an IRA, when I ask people what they stand for, and Mark, I'm not going to put you on the spot, 99.9% of people will tell you that an IRA stands for an individual retirement account. It does not. It stands for, very, very specifically, an individual retirement arrangement. And you can have as many of them as you want. So let's say you got $1 million IRA, and for some reason you want to put $100,000 into real estate. The first thing that I want you to do is to separate that $100,000 into a separate IRA, right? That way, if you're poking the bear and the IRS challenges it, and they will if they can, and if the IRS challenges it, you only have that $100,000 at risk. Because the bottom line is, if you used 100,000 of the million and you kept it in one account, you could find yourself in 1 year with penalties and taxes on the full million because a sliver of it was used for something that they didn't like. So you can have literally a 1,000 IRAs if you wanted to have them. So that'd be the first thing. I would separate it. Second, understand that there can be no leverage that's used with that IRA investment, right? You cannot go to the bank and borrow money against an IRA. You cannot use you can never use an IRA as leverage. That's right in publication 590. And so when you're buying real estate, you know, if you're doing that, it's essentially all of the cash is there and it's purchased. There are no bank loans. Well, that's not the way Mark would teach you to leverage real estate anyhow, right? I mean, it's just not the best asset. What I would encourage you to do from a planning perspective is look at the IRA. Mark's got your taxes down to zero because of depreciation, the bonus depreciation, whatever. Take the $100,000 out of your IRA, say, go ahead, penalize me, tax me and penalize me. Pay it at the 10% bracket, which you're probably never going to be in again. Get it out of the IRA confines, and then you can go use it to buy real estate to leverage it that way. But if you're going to do it, Mark, make sure that they have a separate IRA, just so that if the bear gets unhappy, you have a limited amount of exposure.
Right. Yeah. So, I mean, so only a small handful of clients of ours have actually invested in real estate with their IRA. Most often they'll try to take the cash out and use the cash to invest in real estate in their own name, because when you have for obvious reasons, that if you have the money in the IRA, those losses and all the beautiful things with the cost eggs won't offset their tax liabilities at the 1040 level. And so what's been good for us lately is that most of our clients, whether they have real estate professional tax status or they have short-term rentals, even though they're paying that 10% early withdrawal penalty, we're able to use that cash to offset the taxation on the distribution and keep it at around a zero, many times at a $0 tax bracket, which is great. Now it's going to get harder and harder to do it. They're creeping into the 10% tax brackets and beyond there as well. But you know, these are, I think I've been asked that question close to 100 times in the past 3 years. They asked me, should I take money out of my retirement accounts to invest into real estate? And sometimes I feel like it's not me to make that decision, and they want me to make that decision for them.
Yeah, and that's because they have faith and trust in you, character trust and competency trust. And so one part of the challenge that we have in the financial industry is we have an inherent conflict of interest, right? I'm responsible for about $650 million of other people's money. And I get paid based on the amount of money that we manage. So if you pull money out to buy real estate, by definition, my income just went down. If you pull money out to go to Tahiti, by definition, my income just went down. And so Wall Street has a vested interest in always telling people, no, 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 no. You know, do you really need to spend that? What if you run out of money? Those kind of things. My deal with God was not to teach people how to hoard, right? So we try to teach people how to effectively use and to spend their money. So when you ask me if you should pull money out of your IRA to invest in real estate, my answer isn't dependent upon whether money's leaving the account or not. It's what's in your best interest from your financial journey. And for some people, there is an abundance of money that is tax deferred that they've got, or they've inherited a large inherited IRA, and it may simply make sense to get it out of the IRA to invest in real estate as a diversification. You just have to be aware of greed. And you say you only have a few people that have done this. I don't know the number of people in 2006 and 7 that tried to take money out of IRAs to buy their second, third, fourth home, down in Florida or places like that, because they watched the appreciation. And they're typically not families that I deal with, but I'm a radio host, right? So I would have people call in and say, here's a great idea. What do you think? Well, no, it's not a great idea, but people did it anyhow.
Yeah. And that's why I say a lot of this is dependent on what's right for you. There's no one right uniform black and white answer on a lot of these things. And sometimes there's additional value if your heart is set on investing in real estate or doing whatever it is that's going to lead you to your dreams. And also you get to use leverage when you have that cash and with mortgages and everything else. You may find that it's worth it not only for the opportunities it creates in the forms of other types of tax savings and cash flow, but also the education you get from being able to buy more real estate and do more landlording and maybe getting out of your W-2 job. But it doesn't always make sense. There's no uniform answer here, and it's a very personal answer that the client has to make, and all we can do is tell them the facts.
Right. If you want to know more about some of this stuff and you want to ask us, you can go to our website, yourlifeafterwork.com. You can go there, ask a question. Somebody on my team is happy to answer, help you collaborate with Mark or whoever else that's out there. But it's very careful. It is, I know we've got to wind down a little bit. The key thing that I would tell you, the two things going forward. One, try not to make silo decisions. Now, if you're not from Indiana, you may not know what a silo is, but you've seen the big silver containers. They either have corns or they have beans. They don't have both. Most people tend to make financial decisions in a silo, whether they take Social Security, whether they buy a real estate property and use their IRA. They tend to look at one singular thing, Mark. And what you really have to do is look at your whole farm operation. And sometimes, many times, that requires the work of a collaborative group of a CPA and a competent advisor that knows how to look at all of the operations to help you come up with the best solution for what it is you're trying to accomplish. The second thing is, I have 2 grown daughters and I have a mom. Father's passed away. I look at 3 tax returns every year to optimize my situation, right? And I think most people focus on their 1040 and they forget about everybody else. Well, I'm not going to spend all of the money that I've accumulated. I don't know when God's calling me home. I don't know when it's going to happen. I know my daughters are going to be recipients. I know when something happens to my mom, what little she has will go to me and my brother. I want to make sure that her return is optimized so that when she has the income that she needs, and that when my brother and I receive the benefit, what's left, that we receive it in the best possible manner. I want to look at my kids, knowing that they're going to be the largest recipient when my wife and I are passed, and make sure that I'm looking at their returns and they're set up to be millionaires upon us dying, right? Do not fail to look at that. The IRS is the largest deterrent to a successful financial journey, and it's one you know about just gets ignored and kicked down the road for no good reason.
Yeah, so I want to get into a Q&A with the audience, and I want to encourage you guys to put your questions in the chats or in the Q&A section. But one thing I'm curious here, we talked about some of the foundational concepts that a lot of people overlook here, and now we have the very well-known financial vehicles for retirement accounts and savings accounts, the IRAs, 401ks, and Roth IRAs. There are other things that we can do in the realm of putting our cash places, right? And there's what do you see as far as the mix of where your clients are putting their cash, or some maybe really often missed opportunities here that you would say around among the general public who don't have access to someone with your level of expertise? Let's say we have someone who may not even be a real estate investor, high, or medium income W-2 job, doesn't really know a whole lot about what to do with their cash.
Well, in all fairness, I would always encourage you to hire a fiduciary, right? My job is to care for your money as if I would care for my own if I'm in the same situation. That's my team's job. It's our mission. It's our purpose. And we do it all day long, every day. I've done it for 35 years, and I've got 38 people on my team. And in all fairness, and I don't mean this rude in any way, shape, or form, Mark, but if I thought one of us could do this on their own, I would think it would be me, not you. Right? I've done it for 35 years. I started 2 weeks before the crash in '87. It's been my life, right? I can't do it on my own because there's too many bloody moving parts. Doesn't matter how bright I am, doesn't matter how much I study, you cannot keep up with changing tax codes, changing economies, a global world with new additions all of the time. And so I need help to be able to filter out that noise, right? So I would tell you that there's a lot of things that people are becoming, having accessibility to without the wisdom to understand the implication, right? So you've got people that are winding up in the crypto world because it sounds cool, in the NTF world because it sounds cool. Mark and I have a friend that lost a couple $1 million. That's like 6 zeros with a number in front of. That's a lot of money. Had access to some of the brightest people on the planet, and it still happened, right? Because there's things there that still need to be worked out. There are things in structured notes that really sound cool, but people don't necessarily understand what they're giving up. We use structured notes. We don't use crypto at this point in time, but we do use structured notes. We do use package deals that are in real estate. Instead of buying a place, we buy multiple places. And some people call those REITs. Just keep in mind, most of the REITs that you're going to invest in, real estate investment trust, have high commissions and are, in my opinion, very expensive to manage internally. I think the underwriters get a lot of money, and I don't think the families that buy them do. There are RIA products that are out there that you have to be a fiduciary to be able to go get. So there is access to other things, but I take people back to 1985. That was the year I graduated from high school, and I made it one match away from getting to state finals in wrestling. And I pinned 18 people with one move. I threw a headlock. They knew I was going to throw a headlock. The ref knew I was going to throw a headlock. I knew I was going to throw a headlock. And I made it one match away from getting to the state. Now, my point of this is you don't have to have a toolbox with 75 different things just because you can. What you have to have is a strategy that you understand very, very clearly and make it work very, very effectively. And the best way for you to start is to understand your tax return.
Wonderful. And I have a lot of posts about people who DIY their own tax plans before they come to us. And we have seen some things. We saw one where a client ordered a cost segregation study, absolutely zero value, because the client couldn't use the losses to offset his W-2 liabilities. And in fact, the client ever did get to in the future, he missed out on the opportunity in future years. We saw one of the most unique things I've seen in a DIY tax plan gone wrong was a client did a 1031 exchange, but he didn't realize the property was selling for a loss. So instead of, now here's the thing, one way that you can use real estate losses to offset your W-2, if you don't have rep status or short-term rentals, if you just sell a property and there's no cap gains and you have suspended losses that were unused, you get to free up those losses to offset your active income. But if you 1031 it, just like it would defer cap gains, now you're deferring your cap losses and you lose your losses. And you got to pay us more money to report a 1031 exchange because it takes a lot of time and documentation. So, I think it's just like you wouldn't want to do your own root canals for you, I say. And just like you probably wouldn't waste your time changing your oil, and you might mess some things up. You can DIY some things, right? I mean, but when it comes to tax planning, it is so complex and it takes us thousands of hours. And I can't even do all the tax planning. Sometimes I need a team to help me with the research. I have a team right now helping me evaluate state level pass-through entity tax elections for S corps and partnerships because there's too much. So and for anyone to think that they can do this all on their own at the same level, or that when you look at this as an investment and it's not going to be able to be justified, then you're missing out on a lot of opportunities.
I think you just have to ask it, is the juice worth the squeeze?
Yeah. Okay. I guess
if you want to spend your entire life doing the work to manage your account, maybe you can, maybe you can't. But I would much rather see you enjoy a round of golf, and we get efficiencies in mass.
So I have a question here. The question here is, I have a retirement account. I have I have all my retirement money in a target retirement account with Vanguard 2040. I have 2 rollovers coming to me now from Fidelity and Empower from prior company 401ks that are also going to be Vanguard accounts. What do you think about having all my eggs in one basket? I am self-employed and looking into opening a solo 401k. What are your thoughts on the solo 401k? And you can see this in the Q&A in case that was a pretty heavy question and you need to reread it.
That's a case study, for the record. So let's take this down. So first of all, on the solo 401k, let's start there. I'm all in favor. A solo 401k means you and your wife, not you and your kids, and no other employees. So people mistake that. Your spouse can indeed be part of a solo 401k, keeps you from filing the 5500s with the IRS. If it's a solo 401k, you can open that up. It is a great plan. You're limited to the amount of money that you can put in before you have to report the 5500. So you may very well want to roll money out before it gets too big, and make contributions. There is a rule inside of the tax code. You've probably been told if you're over 50, you can put $27,000, $28,000 or so into a 401k. You can really put close to $59,000 in if it's structured correctly. Mark can help you with that to get it up and done. So you can put more money in that plan than what you may be aware of if it is properly structured by using what I call a mega Roth concept. So you're taking money that you wouldn't be able to defer anyhow and making it a Roth money, a much larger contribution than you would normally make. Empower means you are probably with a 403b, a hospital or a school system. 403bs and 401ks are identical. There is no problem with having it all at Vanguard. I don't use Vanguard. I was writing a letter to John Bogle the day that they announced that he passed away back in 2019, because he refuted many of the things that he said from his Princeton survey that actually created Vanguard. So when you look at life as a fiduciary, it sounds to me like you're doing this on your own. I call it the fiduciary focus. There's 4 things, not one. There's 4 things. You have to manage risk and volatility, fees and expenses, taxes today and tomorrow, and real return, meaning you're always paying attention to inflation. Most of my engineers came from Vanguard before they arrived here with me. And it's because at Vanguard, you could quantify and control fees and expenses. That was their baby, their sweet spot in the market. But by focusing on that one thing, you ignore the ability to contain risk and volatility, especially taxes today and tomorrow and real return. Now, you've tried to address the notion of volatility and risk with a target dated fund. And for those of you that don't know, a target dated fund is a way, it's a great concept. You'll find it in a lot of 401k plans today where it'll have the name of a fund and then a date behind it. And the theory is as you age, you need to have less and less exposure to equities and more exposure to fixed income. That's the theory, right? So if you had a 2025 target dated fund, it would have more bonds than it did stocks. And if you have a 2040, it's going to have more stocks than it does bonds. Now, the problem with that is the last 2 years have proved that the bond market has an ample amount of volatility. They are not negatively correlated to stocks. That's one issue that's there. And two, I don't think it is the best way to be able to manage money, though it is a solution for people to be able to use. You pay Vanguard a little bit of extra money, just a wee bit, and it automatically takes money from one fund and puts it in another to do what we call rebalancing. I think you would find a more efficient way contacting me or somebody else who manages money effectively and find out how that model works where you're building your own target dated fund, if you will, except it's designed specifically for you. But good luck with the 401k. The somebody who's helping you set up the 401k, if you're not doing it on your own, is likely to tell you that you could roll those transfers into your 401k if it was properly set up. That is accurate. Just be aware of that threshold of the amount of money you can have in it.
Wow, that is an awesome answer. Very detailed. Really appreciate it. And we were talking about how we can align when we talk about aligning these strategies and not rollovers but transfers. We had a client who inherited a ton of real estate from her mother and had to take it over and got rep status, and she was interested in cryptocurrency. So one idea here was she had some 401ks from her old job, and we could transfer them into a Roth. And she now has all this real estate depreciating, and she's at a $0 tax bracket, and maybe even has some additional losses from that new depreciation of some real estate at that step up basis now. So definitely going to get some losses. So we could transfer the 401ks into Roth and then invest and grow that cryptocurrency tax free. So lots of cool stuff there when we're looking at all the moving pieces here.
So just keep in mind, Mark, what you just said right there. So I used to have people tell me Roths were risky, right? Remember, there's a tax code and there's an investment. The crypto is an investment that they put into a tax code called a Roth IRA, right? You can have CDs in Roth IRAs. You can have blue chip stocks in Roth IRAs. You can have whatever you want. The Roth is a tax code. Crypto is a pseudo investment. So don't confuse those two as you hear them, but do take advantage of stepping up basis where you can, using 0% tax returns, right? Doing those Roth conversions. And remember, they have to be done by year end.
Yeah. So we have a question from one of your former students.
So,
Ashley Morris, great to see you.
Ashley.
Yeah. So Ashley's on, she's got a great question. First off, she says, Big Joe is the man, and she would love to hear strategies about early retirement, the early retirement movement, and how this is taken into account with a mix of qualified plans and cash flowing real estate.
So Ashley, it's great to hear from you. And keep in mind, she's got her degree from Purdue University in financial planning. This is one of those questions that's really kind of an opinion, more than it is a dyed in the wool answer that you could use on a test. There is there is a large group of people who are leaving the workforce earlier than they anticipated that I think was accelerated by the pandemic. And the thing that I would remind people that you talk to and the people listening to this program is that retirement is never based on age any more than money is. Retirement is based on maintaining a standard of living when you walk away from the workforce, right? And so the idea of having real estate or any other investment that provides passive income is a beautiful deal, right? I've got families that have 100 rentals. That is not passive income because they get calls at 2 a.m. to go unfreeze a garage door with a hairdryer, or to worry about a roof when the snowstorms just came through Indiana here recently. Those kind of things. To me, that is not passive income. That is a different form of a job, right? And so you kind of have to work that into the deal. But if somebody's retiring early, and you can go back to that first question, Mark, that the gentleman had about the solo 401k. One of the ways that we help people get money out of IRAs quicker that are thinking about what Ashley is talking about is setting up a solo 401k, rolling existing IRA money into the 401k, into their solo 401k. Now, why would you ever want to do that? Well, 401k land offers an opportunity for people to get money out at 55 as opposed to waiting to 59 and a half. So if somebody is going to take money out of an IRA before 59 and a half, they have two choices. They're either going to pay a 10% federal penalty, or they have to deal with what's called a 72T, which is a substantially equal periodic payment unchanged for the greater of 5 years or 59 and a half. Every word in that sentence matters. Don't miss it. Ashley didn't on the final exam. So by setting up the solo 401k and moving money into it, and then lo and behold, I'm 55 and retire, you can actually take the money out of the 401k where you couldn't out of an IRA. And as long as your earned income was low enough, there's no tax penalty at all. And you have the ability to do that and create that income stream to be able to retire early. Ashley, I hope that answered the question. It's, it's as I told you 10 years ago or 12 years ago now, whenever it was, I've seen a lot of people get wealthy doing a lot of different things, whether it's investing in stock or whether it's investing in real estate. You just have to be very, very focused. And I think you have a better life if you're diversified than if you're in one area where you maintain and endure a lot of risk.
Yep. And so the way I look at some of these things now, some people glamorize real estate investing. And because, obviously in the tax code, they call it passive income. A lot of our clients are first year early stage investors, and they're always surprised to find how hard and how much work and how stressful real estate investing can be.
Yeah, the IRS calls it passive, but it doesn't sound passive to me at 2 a.m.
Yep.
I own my building, I own my house. That's it.
Yeah. And then a lot of people want to dip out. They said, well, this is not for me. This is not what I thought it would be. I am not living this like luxury life that I was hoping for. And so then for the people who exit, one of the things they didn't learn, they learned about all the tax advantages. No one got a chance to educate them about depreciation recapture in all the glamorous stories about real estate investing. So even if they saw it break even, so yeah, lots of planning and conversations. But here's an opportunity here is if you do want to become more passive, and if you can hire a property manager and you're in retirement, you may be in a low enough tax bracket that you don't need to materially participate for rep status. And if you're living just off the cash flow and it's offset with depreciation, or maybe you even put the funds into syndications down the road, or you can roll them into Delaware statutory trusts. There are ways that you can defer capital gains and some depreciation recapture and live a passive life, have passive cash flowing income where you're doing minimal work.
Absolutely. There are a lot of options, but again, you get into that, proceed with caution and make sure you're working with a collaborative, cohesive group of people who understand that, who can look at it from different sides.
Yeah.
I love the Heath brothers, Chip and Dan are authors. One of their books is called Decisive. And it's kind of the art of decision making. And I would, before you make a major decision like that, I would read the book and just think about your metrics for making a decision so that you've thought about it as clearly as you can, both the good and the bad. But use Mark or somebody who's qualified to help you walk through those technical loopholes.
Awesome. Well, Joe, we're at about time. Can you tell everybody how they can learn more about from you and where they can access some of your material and content and use your services?
Sure. You can go to yourlifeafterwork.com. People ask why it doesn't say Financial Enhancement Group. I started the company in 97. And if you misspelled something, Google didn't take you anywhere. Your Life After Work, that's hard to mess up. It's a little long, but yourlifeafterwork.com. You can get signed up for our weekly, since 2007, we send out a video commentary about what's going on in the market. It comes from my CFA and our chartered market technician. And Elements in Focus comes from my director of financial planning and manager of advisor operations. Those are free things that we send to the public to try to help. You can get signed up for a next steps meeting where somebody on my team will call you and actually ask questions. Like I said, we take care of people in 31 states, and they're a family just like you. But it's yourlifeafterwork.com, 800-928-4001.
Okay, and one more question. What do you do for fun? Tell us something interesting about you.
I golf. I just took the ice pack off my knee. I am an avid golfer. It's the hardest thing I've ever done in my entire life. I've been married to my wife for 35 years. And I frequently share with her if dating was this hard, I'd still be single. And yet I injure myself, and I will do it anytime that I possibly can. But I love a game that simply can't be licked.
Okay, maybe I should probably start golfing.
I would not encourage that. You're too young. I took 10 years off to raise the kids and build the company. Now I get to do it and have a little bit of fun. But no, it is a wonderful, wonderful game, Mark.
Nice. Well, I like cooking because I have to cook anyways. Might as well enjoy it, have some fun with it. So, all right. Well, hey, you guys can watch the recording. It's going to be published on my YouTube and the podcast. Joe, I might actually reach out to you guys to see if you help my dad. And Joe, I really appreciate your time. You definitely provided our guests and me with a lot of really great ideas and wisdom and insight here. Really enjoyed this conversation, and thanks a lot for your time.
Thanks for having me, Mark. Y'all have a great night. Ashley, it was good to hear from you.